There are several ways that Canadian investors tend to play defense and protect their investment portfolios. Usually for stocks, people like to buy high quality companies and hold on to them until it doesn't work anymore. But from a stock market freefall scenario, I was curious as to which Canadian stocks actually lost the least over different bad events. So there's 5 periods in recent time that I really wanted to test out. Although every market drawdown had its own reasons, it's interesting to see how each idea reacts to a stock market downturn over a short period of time. The first is the Great Financial Crash in 2008 to 2009. Second is the sovereign debt crisis in 2011 to 2012. Third is the China slowdown on top of an oil price crash in 2014 to 2015. Fourth is the US versus China trade war of 2018 and 2019. And fifth, of course, is the COVID-19 global sell-off of early 2020s. These are the exact dates I'm using for each scenario if people are curious, and this was the damage done to the Canadian markets. Interestingly, I wanted to point out that even though we're still in the COVID situation, I'd like to think that the amount of debt that's being piled up by companies and governments around the world, I think the big concern is how it's all going to be paid back or if there's the means to. So in the future, we might be seeing a repeat event of the sovereign debt crisis from 2011. I wanted to quickly mention that academically speaking, stocks in certain industries often have particular moments during an economic life cycle that they have better or worse performance. Since I'm only talking about a downside of a short economic cycle, or the recessionary phase, typically stocks classified as utilities, consumer staples, and healthcare should be outperforming. Underperformance is more expected by real estate, industrials, information technology, and communication services. We'll see if this has occurred in recent major events in stock market history. So I created a table of the TSX60 companies and how harshly they dropped in the market during bigger sell-off moments in history. For those that don't know, the TSX60 is basically 60 of Canada's largest companies. For simplicity, the sell-offs are strictly based on price changes during the specific periods and don't consider dividends received or company-specific events going on. Right now, the list is set from the largest to the smallest company, but quickly running through each scenario in time. In the 2008 Great Financial Crash, the companies that had the lowest losses were OpenText, Kinross Gold, Agnico Eagle Minerals, Metro, and Barrick Gold. In fact, they all made money during this period. Meanwhile, the biggest losses were Teck Resources, Gildan Activewear, Manulife, Magna, and Sun Life. In the 2011 sovereign debt crisis, the companies that had the lowest losses were Canopy, Alimentation Couche-Tard, Constellation Software, Pembina Pipeline, and BCE. In fact, they and many others were gainers during this period. Meanwhile, the biggest losses were First Quantum, Teck Resources, Suncor, Canadian Natural Resources, and Cameco. In the 2014 China slowdown with oil crash, the companies with the lowest losses were Alimentation Couche-Tard, CCL Industries, Constellation Software, Metro, and CGI. Meanwhile, the biggest losses were First Quantum, Teck Resources, Kinross Gold, Barrick Gold, and Canadian Natural Resources. In the 2018 US-China trade war, the companies with the lowest losses were Barrick Gold, Gildan Activewear, Alimentation Couche-Tard, Algonquin Power, and Thomson Reuters. Meanwhile, the biggest losses were First Quantum, Suncor, Canadian Natural Resources, CCL Industries, and Manulife. And in the 2020 COVID-19 global sell-off, the companies with the lowest losses were Metro, Loblaws, George Weston, Wheaton Precious Metals, and Barrick Gold. Meanwhile, the biggest losses were Canadian Natural Resources, Inter Pipeline, Gildan Activewear, Suncor, and Imperial Oil. When you average out the 5 historical events, the lowest losses were Metro, Constellation Software, Alimentation Couche-Tard, OpenText, and Agnico. The biggest losses were by First Quantum, Teck Resources, Canadian Natural Resources, Suncor, and Manulife. But of course, there's winners and losers within respective industries, so let's see how companies did within their own sectors. For financials, we mostly have banks, insurance, and investment companies. Here they're arranged from the largest to the smallest in market size. On the bottom, I'll show the averages for the different groups and the entire sector. From best to worst, here's the ranking for the 2008 Great Financial Crash. The best were Thomson Reuters and National Bank. For the 2011 sovereign debt crisis, the best were Brookfield Asset Management and BMO. For the 2014 China slowdown with oil crash, the best were Thomson Reuters and Brookfield Asset Management. For the 2018 US-China trade war, the best were Thomson Reuters and Brookfield Asset Management. For the 2020 COVID-19 sell-off, the best were Thomson Reuters and RBC. And for the average of the 5 historical events, the best were Thomson Reuters and Brookfield Asset Management. From my observation, the entire financial industry had losses in every period, but the best defensive names were Thomson Reuters and the banks, while the least were the insurance companies. The banks on average were 8% better than insurance companies in every scenario. For energy, we mostly have integrated and pipeline companies. Integrated are those involved in production and refining of oil and gas. Pipelines are only concerned about delivering it. Here's a ranking for the 2008 Great Financial Crash. The best were Enbridge and Imperial Oil. For the 2011 sovereign debt crisis, the best were Pembina Pipeline, Enbridge, and TC Energy. I think it's pretty interesting that the pipelines came up positive during this period. For the 2014 China slowdown with oil crash, the best were Enbridge and TC Energy. For the 2018 US-China trade war, the best were Enbridge, Pembina Pipeline, and TC Energy. For the 2020 COVID-19 sell-off, the best were TC Energy and Enbridge. And for the average of the 5 historical events, the best were Enbridge and TC Energy. From my observation, the entire industry lost money on every occasion, but the pipelines on average lost 17% less in every scenario compared to the integrated energy companies. For utilities, there are companies involved in either the generation or transmission of electricity. Academically speaking, this is an industry that's set to outperform during a down market. Here's a ranking for the 2008 Great Financial Crash. The best was Emera. For the 2011 sovereign debt crisis, the best was Algonquin. For the 2014 China slowdown with oil crash, the best was Algonquin. For the 2018 US-China trade war, the best was Algonquin. For the 2020 COVID-19 sell-off, the best was Emera. And for the average of the 5 historical events, the best was Emera. From my observation, utilities show some strong gains on occasional periods, but it wasn't completely immune to all market downside scenarios. For telecom, there are companies involved in wireless, wireline, or marketing. Academically speaking, this is an industry that's set to not perform during a down market. Here's a ranking for the 2008 Great Financial Crash. The best was Shaw Communications. For the 2011 sovereign debt crisis, the best was BCE. For the 2014 China slowdown with oil crash, the best was BCE, followed closely by Rogers. For the 2018 US-China trade war, the best was Rogers. For the 2020 COVID-19 sell-off, the best was Rogers. And for the average of the 5 historical events, the best was BCE, followed closely by Rogers. From my observation, telecom wasn't that bad, despite some vulnerabilities, and it actually performed much better than most other industries. I think that sticking with the big two, Rogers and Bell, would have been better for pure defense. For industrial, it includes a diverse range of businesses like railroads, toll roads, and civil engineering. Academically speaking, this is an industry that's set to not perform during a down market. Here's the ranking for the 2008 Great Financial Crash. The best were Canadian National Railway and SNC-Lavalin. For the 2011 sovereign debt crisis, the best were Brookfield Infrastructure and Canadian National Railway. For the 2014 China slowdown with oil crash, the best were CCL Industries, Waste Connections, and Brookfield Infrastructure. For the 2018 US-China trade war, the best was Waste Connections. For the 2020 COVID-19 sell-off, the best were Waste Connections and Canadian National Railway. And for the average of the 5 historical events, the best were more like Canadian National Railway and Waste Connections. It wasn't the top 2 because Brookfield didn't experience 2008, and CCL Industries had one extraordinary year, but other years were pretty bad. From my observation, industrials as a whole noticeably did lose more as an industry. Canadian National Railway was on average better than CP Rail, but the rest of the industry doesn't really seem correlated in performance since they're all very different businesses. For materials, it includes those in mining or the royalty business. Mining companies are concerned about the extraction and ownership of minerals. Royalties just own a small portion of the minerals and don't have any mining operations. Here's the ranking for the 2008 Great Financial Crash. The best were Kinross Gold and Agnico Eagle. For the 2011 sovereign debt crisis, the best were Franco-Nevada, Kinross Gold, and Agnico Eagle. For the 2014 China slowdown with oil crash, the best were Franco-Nevada and Agnico Eagle. For the 2018 US-China trade war, the best were Barrick Gold, Kirkland Lake, and Cameco. For the 2020 COVID-19 sell-off, the best were Franco-Nevada, Wheaton Precious Metals, and Barrick Gold. And for the average of the 5 historical events, the best were Agnico Eagle, Franco-Nevada, and Kinross Gold. From my observation, the materials industry was harder hit in performance, almost to the severity of energy pipelines. But you'll find some bright spots like Franco-Nevada, which I find is the most consistent for defense. For technology, it's mostly software companies. Academically speaking, this is an industry that's set to not perform during a down market. Here's the ranking for the 2008 Great Financial Crash. The best was OpenText. For the 2011 sovereign debt crisis, the best was Constellation Software. For the 2014 China slowdown with oil crash, the best was Constellation Software. For the 2018 US-China trade war, the best was CGI. For the 2020 COVID-19 sell-off, the best was Constellation Software. And for the average of the 5 historical events, the best was Constellation Software. From my observation, the tech industry wasn't actually that bad for down periods. For consumer, stocks range from food, clothing, and car parts. To be distinctive, consumer stocks are either classified as staple or discretionary businesses, which is basically saying essential versus non-essential businesses. Academically speaking, this is an industry that's set to outperform during a down market. Here's the ranking for the 2008 Great Financial Crash. The best was Metro. For the 2011 sovereign debt crisis, the best were Dollarama and Alimentation Couche-Tard. For the 2014 China slowdown with oil crash, the best were Alimentation Couche-Tard, Metro, and Dollarama. For the 2018 US-China trade war, the best were Gildan Activewear and Alimentation Couche-Tard. For the 2020 COVID-19 sell-off, the best was Metro. And for the average of the 5 historical events, the best was Metro. From our observation, the staples were on average 20% better than the discretionary companies, but they weren't completely immune. For real estate, there's only 2 companies, and they own commercial and residential properties. Academically speaking, this is an industry that's said to not perform during a down market. There's not a lot of options for real estate in the TSX60, but the longevity and recent performance of Canadian apartments has made it a pretty solid pick. For healthcare, there's only 2 companies, and it's in pharmaceuticals and cannabis. Academically speaking, this is an industry that's set to outperform during a down market. There's not a lot of options for healthcare in the TSX60, and I think the healthcare industry did not outperform. When putting all the major Canadian industries and sub-industries side by side in terms of average performance, here's a table of each that we went through. Here's the ranking for the 2008 Great Financial Crash. The best were technology, pipelines, and mining. For the 2011 sovereign debt crisis, the best were real estate, healthcare, pipelines, and telecom. For the 2014 China slowdown with oil crash, the best were technology, staples, utilities, and real estate. For the 2018 US-China trade war, the best were utilities, staples, telecom, royalties, mining, and healthcare. For the 2020 COVID-19 sell-off, the best were royalties, staples, telecom, and utilities. And for the average of the 5 historical events, the best were staples, technology, utilities, telecom, real estate, and royalties. So that's all for now. If you thought that this data was insightful, remember to like, subscribe, and turn on notifications for new investment topics in the future. Let me know in the comments below what Canadian stocks that you invest in for defense, and I'll see you next time.